Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-eitel.
All right, my name is Mark-eitel, and you are listening to the Mr. Mortgage Show. And friends, you're in the right place if you want the information, not the headlines. We throw the headlines right out the door, and Dom and I dig in each week to the data behind the headlines to give you the information that you need so you can go out there and make better real estate and mortgage decisions for you and your family. We do this each week right here, same time, same station. Always appreciate you spending a little bit of your weekend with us. We've got a great show dialed in for you this week. We're going to dig into the CPI numbers. What does that mean for interest rates? What does it mean for housing? Is this house of cards finally starting to teeter? Is the teeter going to totter? Is it a good time to buy, sell, refi? We're going to dig into all that. We're going to take your questions. Guys, your questions are always my favorite part of the show. And in addition to producing the show, Dom is also manning the anytime hotline, and he'll get your questions on the air. You can call or text the anytime hotline, which is 855-462-7292. That's 855-462-7292. If you prefer to shoot him your questions via email, he's monitoring that too. Just go to the website, which is mr.mortgage, never a .com. Just go up to the address bar on your browser and type in Mr., hit the period, type in mortgage, hit enter, boom, the page will pop right up. In the upper right-hand corner is a contact us box, and you can type your question there. Hit submit, and Dom will read it on the air for you. So, guys, as I mentioned, it was another crazy week. I don't know about you guys, but I'm so glad the elections are behind us. My God, have you ever seen so many grown adults dodging questions like the politicians? I always find it fascinating when you watch some of these debates, and what seems like a very clear and concise question that needs only a yes or no answer can be turned into a 2 or 3 minute diatribe completely off topic. And by the time they're done answering, you don't even remember the question. And I guess that's the point, right? A lot of them don't want to be pinned down on any of the hot topics. But hey, you know, I don't do politics, but I do want to say this. I don't know how many of you were chasing that $2 billion lottery last week, right? That big lottery that was what, the Powerball? And I guess somebody in California won that. So interesting to see what they do with that. But I find it fascinating that we're, 4 days after the election, and we're still counting ballots in some of these states. And I'm referencing the lottery because let's back up the week prior to this $2 billion, because I know there was a hiccup and a delay in counting or picking the winner for this most recent lot or Powerball, but the week prior to that, it was $1.6 billion. So I did the research. 558 million tickets were sold that week. Now, guys, there are only 300 million people, or give or take a little more than 300 million total people in the U.S., but over 558 million tickets were sold, right? And that week, we knew the results in hours. And here we are in Arizona and Nevada, where there is 1.8 million and 4.1 million registered voters, total registered voters. And, they can't even get the results to us 4 or 5 days later. So maybe we should let the lottery officials count the votes, because they seem to do a much quicker job. But anyway, that's as political as I'm going to get. I just find it fascinating that we're, waiting days to count, less than 1 million votes when we're getting lottery results based on 558 million possible winners in just a few hours. So anyway, I'm going to leave that right there. You guys do with that what you may. Maybe you can win a beer at the bar with a trivia question asking how many registered voters are in those states, or how many people bought lottery tickets the week prior to the $1.6 billion lotto. But anyway, a lot of news this week in the financial world around interest rates relating to the CPI numbers that were released Thursday. And those numbers show that inflation appears to be cooling. And because of that, we had a big run up in the stock market. And we had a really, really encouraging day in the interest rate market as a result of that. And the theory is that if inflation is finally starting to cool, that the Fed will start, slowing some of these hikes, or at least put some of them on pause. The jury's out for me on that. I'm not completely convinced that that's going to happen, and I don't think this inflation number is a direct result of anything the Fed has done so far. But it's interesting. We dug through the data, as we always do, and it was quite interesting that there were some areas of the economy that were still seeing big double-digit increases, and that was food and heating oil and energy costs. So a lot of that is the stuff you can't live without. So I think while the headline number was attractive for a lot of people, and a lot of the economists are, ringing the bell saying, okay, we're finally on the downside of inflation, I just caution you not to get too optimistic, because while inflation is slowing, we're still seeing inflation. We were still 0.4% month over month, and we're seeing, I think it was 7-point-some% year over year. So we are still experiencing it, just appears to be slowing. And then the can't live without categories, food, gasoline, heating oil, for a lot of the country, they're still seeing significant inflation in those categories. So just, mind yourself accordingly, be cautious. I don't think we're out of this inflation cycle yet, but it's encouraging to see that we may be on the downside of it. And if we're on the downside of it, logic dictates that at some point here in the future, the Fed's going to ease off the throttle with these interest rates. But I found that encouraging. It was really nice to see interest rates slip back in the sixes on Thursday. And we had a lot of happy clients, because most of the people that have been shopping for homes in the last 2 or 3 weeks were conditioned to think they were going to pay a rate in the sevens unless we use that seller contribution to buy the interest rate down that we talk so much about. And guys, if you have questions about that, I'm always happy to explain that, because I do truly believe that's a great opportunity. And it's still an opportunity. If rates are in the sixes and you can buy them down in the fives, hey, you're the big winner. And the fact that rates pulled back a little over a half a point on Thursday is giving us a lower starting point to buy the rate down from. So I found that super encouraging. Anyway, we're going to watch the rates. We're going to watch the economic data that controls the interest rate environment. And although you've heard me say it 100 times, the Federal Reserve interest rate hikes don't directly control mortgage rates. Everything does have a tendency to move in the same direction. And we can deep dive what's pressuring the interest rates to move higher. A lot of it has to do with the liquidity on the secondary market. I'm not going to go into that unless you want to. If somebody has a question about it, feel free to call or shoot your question to 855-462-7292, and Dom will get you on the air. But I did find that fascinating. So we dug a little deeper into housing data, and we see that still a lot of the country is experiencing a ton of equity. We're still experiencing year-over-year appreciation, although we're seeing that slow down a little bit, right? I think we're at about a 8 or 10% appreciation rate. And I've told the story on the air before, and I'm happy to tell it again if ever anyone's interested in hearing it. But I bought my first house in my very early 20s with a 10% interest rate and a 3% appreciation rate, which is kind of where we're headed into 2023. We might not catch a 10% interest rate, but we're certainly not in the 2s or 3s like we were last year. And the appreciation is not in the, high double digits or, 20% or 18% like it was last year. But even at a 10% interest rate with a 3% appreciation rate, that was my smartest move I ever made buying that house. It really set me up for the future. I built equity slowly but surely. I didn't, double my money in 2 years like a lot of people have. But I'm saying all that because the headlines can be discouraging. We're seeing people every day that are making decisions just based on the headlines. And if you read the headlines and it says the housing market's slowing, prices are coming down, and interest rates are forecast to slip back down, it gets super logical to think that, maybe waiting makes sense. But all of that forecast, all of those people who had the information last year were wrong with their forecast too. So it's always better to use the data of today and not wait for something better to change in your life to make that decision. Because if you can do it today and things get better, then you're that much farther ahead of everything in the future. But hey, guys, you hear that music? You know what that means? That is my cue. We're going to take a short break. We'll be back in 2 minutes. Sit tight during this short commercial break, and on the other side of this, Dom and I are going to dig into your questions and bring you more of the Mr. Mortgage Show. We'll be right back. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Here's another 5-star review.
My wife and I own a small business, and the way our accountant files our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage, but not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. You heard the man, 855-462-7292. That's 855-462-7292. You can call or text your questions to that number. And Dom, my amazing producer and sidekick and partner in crime here, he'll get your questions on the air. That's 855-462-7292. Or visit the website, mr.mortgagenever.com. Heck, leave off the W's, leave off the .com. Just go up to your address bar and type in Mr., hit the period, type in mortgage, hit enter, will pop right up. There's a contact us box on the upper right-hand corner. You can type your question there, and Dom will get it via email. So super excited to get to your questions. But before I do, I was kind of rambling a bit there at the end of that last segment and lost my train of thought. And I found my train of thought. My train has come on in. I was talking about the vast majority of owner-occupied U.S. households either don't have a mortgage or are in great shape with equity and on-time mortgage payments. We talked a little bit about that last week, and we're watching that number very closely along with the unemployment rate for any tips of trouble in the real estate market. That's where our focus is right now. Because our beliefs are, if you're in your home already, you most likely got a super low interest rate. You most likely are making those bills on time. And as long as you keep your job, you're going to continue to do so. And the data that we've pulled up really, really supports that. 96%, little over 96% of U.S. households either have no mortgage at all, meaning 100% equity, or they've got equity and their mortgage payments are on time and they're happy with that super low interest rate. So less than 4% of the U.S. owner-occupied mortgage households fall out of that category. So that's a pretty healthy number to be, kind of fat and happy and sitting at home making out okay in this economy. So that's super encouraging. Unemployment's still really, really low. And guys, interest rates in the 6s or 7s, I mean, that's a historically affordable interest rate. And I do believe they're going to fall down a bit from here. I just don't think we're ever going to see 2s or 3s again in our life. And I don't think we want to, guys. I mean, think about what we went through to get to those interest rates. We had to turn the whole world upside down, lock people in their homes, get them vaccinated, make them wear masks, and not let them participate in their day-to-day life to force the economies of the world into an environment that drove interest rates down into the 2s or 3s. So if you want to go to work every day and have a healthy economy and be able to travel and see your loved ones and go to church or school and live a normal life, well, guys, we're going to have to pay normal interest rates too, because that's just part of the normal cycle. So I am of the mind that they are going to come back down. I think this is a little bit of an overreaction to inflation and the Fed tightening the policy and not buying mortgage-backed securities. But I don't think we're going to go back to the 2 or 3s. I think we settle somewhere in the 5s, but that's just me. I'm an armchair economist. I've been doing this since 1999, but I do not have a fancy title, and I'm not on CNBC every day. I'm just here with you every week. So anyway, you've heard me reference your questions. They are always my favorite part of the show. So let's get right to them. I'm going to let Dom get started. I'm going to throw it over to him for a question.
Sheila just emailed us. Does it matter which debts we pay off with a rec refinance? We've been holding off waiting on rates, but our credit cards are getting out of hand.
Hey, Sheila, that's a great question. And you're not alone, right? Because as I mentioned in the opening segment, the Federal Reserve overnight rate, or the prime rate, when he moves the interest rate, that affects things like credit cards. If you've already got your mortgage and you're in a fixed interest payment there, or you bought your car 2 years ago, that doesn't impact you. But credit cards, any adjustable rate debt, home equity lines of credit, anything with variable interest rate debt is going up every time he makes that adjustment. So we're talking to more and more clients who have a super low interest rate on their first mortgage, but they've gotten careless with their credit cards. Some of them bought cars and campers and four-wheelers and boats. Remember when you couldn't buy boats during the pandemic? Everybody was running and buying boats because they wanted to get out and do something with their family. And I know there was a big push on RVs. I've talked to many clients who have a big, beautiful diesel pusher now, either in storage or sitting along their house, because during the pandemic, they were going to live that travel bug life. And now they're just looking at it out the window and making payments. But that's a great question. No, you can pay off any of the debts that you want. Naturally, we're going to do the refinance on the house, so that loan is going to get repaid, the mortgage. But if you want to roll credit cards, cars, equity lines of credit, boats, whatever debt you're trying to alleviate, you can roll into that rec loan. And for anybody who's listening and doesn't know what Sheila and I are talking about in the rec loan, rec stands for Reduce, Eliminate, and Consolidate. And it's a specialty refinance that we developed. There are some lower fees associated with it compared to a normal refi, but it's designed to lower your monthly expenses. And I'm going to encourage everybody to Google effective interest rate or refi roll down, and you'll see where people have done these calculations, and there are online calculators. You know what I'll do? I'll make it easy on everybody. I'll just post it to the Facebook page. Go to Facebook and search The Mr. Mortgage Show, and I'll pin it to the top of the page. But you can plug in all of your debts, right? Let's say you've got a first mortgage with a 4% interest rate, but you've got these credit cards at 22 and 26% or whatever they are. You know your personal situation. But you can plug in all of those debts and then see what a refinance at 6%, what that would do for the effective interest rate, because you're going to be surprised at what you're actually paying monthly right now in the form of an interest rate, because it's a lot higher than 4% when you calculate all of those other payments. And I was talking to a gentleman yesterday, and he's in the same situation, and he's got 3 credit cards, and he's throwing hundreds of dollars at these things every month, and they're not moving. And it's directly related to that super high interest rate because they're adjustable rate debt, and the Fed just took another swing at interest rate hikes last month, or earlier this month rather. So anyway, that's a brilliant question. The rec refi, any of your consumer debt, we can roll that in. And you can pull some cash out with that refi too if you wanted to do some home improvements. So Sheila, thanks for that question. But let's keep your questions rolling. I'm going to throw it over to Dom for another one.
Kevin called in asking, with this week's CPI number being low, do you think rate hikes will end now?
Hey, Kevin, you, me, and everybody else wants to know, right? What was that old commercial? Who's old enough to remember? When E.F. Hutton talks, people listen. Well, right now, everybody's got their ear pressed to the office door of the Federal Reserve, hoping that they get some type of insight whether these rate hikes are going to slow. I am not a huge believer in month-to-month data that signal the end of a trend. I just, in July, we had a 0% CPI, a zero CPI number month over month. So, and then we went back into low increases, but still increases. So the reason I'm saying that is let's get a few months under our belt before we start ringing the celebration bell. I think that we've got some increase in oil prices and gas prices ahead of us as we move into the colder months, heating oil in particular. We've got the uncertainty in Russia still, and that's weighing on the international oil and petroleum market because they supply a lot of the countries in the world. Not us, but if all of a sudden other countries are shopping in the same store we're shopping in, that puts burden on supply. So I'm not super convinced that we've entered a downward trend yet. I'm hoping that we flatten and then we start to ease from here. So to answer your question, brother, I just don't know. I do think more rate hikes are in our future. I don't think they're going to be 75 basis points each time. But I don't think we've left the environment of inflation, nor have we left the environment of the Federal Reserve trying to do whatever they can to slow inflation. And the only tool left in their toolbox is interest rate hikes. And they're trying to make us stop buying things, right? So, and again, we're going into the holiday season when people have a tendency to buy more things. And I find it fascinating that people are so willing to spend on credit cards at these high interest rates and continue the consumer behavior that we've demonstrated all through the pandemic. But that's a long philosophical conversation about economics and human nature. I'd love to have it with you one day. Maybe we'll bring in some smart people to interview on the show about that one time. But brilliant question, my man. I don't think we're out of the woods yet, but there is optimism in the market. We saw what happened Thursday, right? 1,000-point clip upward. And it settled back down a bit on Friday. But interest rates, they thought it was a favorable report. As I mentioned, we pulled back into the sixes. So I am not yet convinced that the Fed puts away his rate hikes quite yet. But let's see what happens. I mean, let's move forward optimistically. And again, guys, I still say the rate environment that we have, you can still make sense of real estate. There are opportunities out there, and I encourage you to go look for them. But anyway, you hear that music. That's my cue. We'll be back in 2. Sit tight for 2 minutes, and we'll be right back with more of the show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell him you heard this on the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you are still tuned in to the Mr. Mortgage Show. And guys, we appreciate you spending some of your Saturday with us. We do this each week right here, same time, same station. Dom is manning the Anytime hotline, looking for your questions, and you can get them to him by calling or texting 855-462-7292. That's 855-462-7292. Again, call or text that number anytime, because that is the Anytime hotline. And we call it that because when I'm not in the studio on Saturdays doing this show with you, that pushes to my office. So we forward it from the studio to my office during the week. So you can get us anytime on that number. You can check us out online by visiting mr.mortgage, never a .com. Just type in Mr.mortgage, it will pop right up. So super excited to spend some of the day with you. We've had some good questions so far. We started with Sheila. Sheila. She was asking about paying off credit cards and some other debts with the rec refi. And I encouraged her to do what's called an effective interest rate calculation and look at, what moving all of that debt into one monthly mortgage payment, even at a 6 or 6.5% interest rate, what that's going to do to her monthly savings. And guys, if you're really disciplined with your bills, and let's say you lower your payments by $1,000 a month by that strategy, if you keep paying that $1,000 a month against your mortgage, just keep writing the same size check, but now all to the mortgage, I think you'd be surprised at how fast you pay that house off and you bring down the cost of that interest rate over time. So super excited to have that conversation. Kevin had some questions regarding the CPI number and whether we think the Fed is done. I don't, but I thought that was an interesting question. If you missed any of the show and you want to hear more of it, visit MrMortgageRadio.com. When we leave the studio, Dom posts the recorded version of the radio show up to the podcast page, which you can find at MrMortgageRadio.com. But anyway, speaking of Dom and speaking of your questions, let's keep the party rolling. Hey, Dom, do we have another one?
We do. Here's a text. They didn't include a name. So this week I read about more mortgage and real estate companies closing or laying off hundreds of people. How can you still be positive about real estate?
Now I know why you didn't leave your name, Mr. or Mrs. Anonymous. So that's a great question, actually. And I laugh only because, again, the headlines, you digest the headlines and you don't really think or look past them. It's easy to be misled by things. And I read the same articles. Redfin was firing 43 people or something to that effect. A lot of the, .com lenders have either greatly reduced staff or closed altogether. So guys, think about it this way. When opportunity knocks, opportunistic people come out of the woodwork. So we just left an environment where interest rates plummeted into the twos, right? So you could take a 30-year fixed rate mortgage in the twos, and I even did some 15-year mortgages in the ones. Wow, crazy to think about that. 30-year debt in the twos and 15-year debt in the ones. That's nuts, right? So as soon as that happened, everybody and their brother with a call center and some headsets turned into a mortgage company. And it was really easy. They had people cold calling all of the homeowners saying, hey, Mr. Johnson, Mrs. Johnson, what's your interest rate? Oh, Mr. Cold Caller, my interest rate is 6%. Hey, would you like an interest rate in the twos? Oh, yes, I would love an interest rate in the twos. Okay, boom, here we go. So all of these companies hired aggressively. A lot of them sprouted up out of nowhere because there was opportunity there. It's, like a T-shirt seller or a ticket scalper out in front of the stadium. There's business there for him at that moment, but next week he's going to be selling insurance or driving Uber again. Once the opportunity passes, they can't afford to stay in business because they're not working with purchase-driven real estate agents or consumers who are trying to buy or refinance their primary, they were set up to take advantage of the opportunity. Well, at the 6s and 7s, that phone call is very, very different. Hey, Mr. and Mrs. Johnson, what interest rate do you have? Oh, hey, Mr. Cold Caller, my interest rate is in the 2s. Oh, well, can I interest you in a rate in the 7s or 6s? No, thank you, Mr. Cold Caller. So you see my point. Suddenly that opportunity no longer exists. They can't afford to keep these people on the payroll, and they close their company, and they'll pop up when there's another opportunity somewhere else. Maybe it's homeowners insurance or life insurance or who knows where. There's always another opportunity. But a lot of these companies weren't built for the fundamentals, the long-term principles of real estate. They were geared up for that opportunity, and when that opportunity passed, they closed down. And to the Redfins of the world, right? Redfin just stopped their house flipping. We saw Zillow last year, I think it was. Yeah, it was last year. They stopped their house flipping. Again, that was never a part of their fundamental business practice. It was an opportunity, so they started a division of the company to go out there and make homeowners an offer to sell their house, and then they put the house right back on the market and made a profit on it. Well, guys, you can do that all day long when homes are appreciating at 20% a year. But if appreciation slows to the projected, 2-3% that we're anticipating next year, that's not a sexy proposition anymore. They'll never recoup their costs in the first 12 months. So I've been around since 1999 in the business, born and raised right here, and grew up in a construction family where we were always in real estate. My grandparents built custom homes for people, and then I got involved in mortgage and real estate in 1999 and started facilitating transactions. We were always about the purchase transaction. So I have a slightly different lens, and maybe I have the advantage of being a little guy that still, talks to my consumer, my client directly, or someone on my team does. I'm not a big .com conglomerate that is only flying in to take advantage of these low rates and then anticipating needing to fly right out of here when rates move. So I know that's probably a long answer to your question, but that's why I'm still optimistic about real estate. And I go back to what I said in the opening segment of the show. I bought my first house with a 10% interest rate, $64,000 house, and a 3% appreciation rate. And it stayed 3% for almost a decade. That's pretty boring. That's not sexy. That's not a low interest rate and fast appreciation and making an opportunistic buck. That was a guy who just needed a place to live, went home every day, laid down my head each month. I wrote that check. I'll never forget it. $561.65 a month was my payment. But guess what? I sold that property, cashed the equity out, bought my next house, moved up. But it all started with that first fundamental purchase. And maybe I'm glad you're asking this question because it's really got my wheels turning. Maybe we need to look at that as the example because we can't look at the last 2 years. That was an anomaly. We need to look at reality. And if reality is an interest rate of 8 or 9 or 10% and appreciation is 2 or 3%, I can show you in my own life how that made sense. So great question. I remain optimistic, but I am going to stop talking about myself and throw it over to Dom, see if we can't get in another question.
We can. Amanda texted this one. I called your office and got some information about the 100% loan program for first-time buyers. I'm excited. Can my parents help with the down payment with this program? Thanks for your help.
Hey, Amanda, thank you for the question, and I'm super excited that you called in. We are looking forward to helping you. So, guys, there is a 100% program out there right now. It's a grant. You don't have to be a hometown hero. I like it better than hometown heroes because the grant portion is forgiven. You don't have to make payments, and you don't have to repay it if you sell the house or refinance it. And hometown heroes, you do have to pay back that grant lives on as a second mortgage. You don't have to make monthly payments, but you do have to pay it back if you sell the house or refi. But anyway, Amanda, to your question, yes, your parents can gift you the down payment. So guys, this is a really powerful tool. It's an FHA mortgage, which is a 96.5% loan. It has broad qualifying parameters, right? FHA has more liberal underwriting guidelines than conventional. And then you get a 3.5% grant on top of it to get you to 100%. The seller can contribute up to 6% to your closing costs, and you can get gift funds from your folks. So I'm excited for you, Amanda, and we are looking forward to working with you. Guys, if you have questions about that program, it is better than Hometown Heroes, because if you're not in one of those hero categories, Hometown Heroes doesn't even apply to you. And this loan program does work for hero category also. It's not cutting anybody out of the equation. So we are super excited to roll that out. And Amanda, thank you for calling the office and checking that out. But hey guys, you hear the music, you know what that means? It is time for another break. That's my cue. We'll be back in 2. Sit tight for 2 minutes. On the other side of this break, we'll be back with more of the show.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark-eitel and the Mr. Mortgage team.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you are tuned in to your very favorite real estate and mortgage show of the week, maybe of all time. Well, it's my favorite show of all time because I get to sit here and answer your questions. Guys, we appreciate your questions, your comments, your well wishes. If you want to call or text, you can get a hold of us at 855-462-7292. That is the Anytime hotline. I know Dom's got some questions over there. We were just talking during the break, but 855-462-7292 is how you get your questions in the queue, and Dom will read them on the air for you. You can always visit the website also, mr.mortgagenever.com. Just try it right now if you're sitting at home and you're in front of your computer. Go up to the address bar in your browser. Don't type in any W's. Just type in Mr. Mortgage and hit enter. I know it's super hard to resist the urge of typing in .com, but we've made it super, super easy. Just type in Mr.Mortgage, hit enter, and the website will pop up in the upper right-hand corner of the page as a contact us box. There you can submit your questions via email, and Dom will read them on the air. And then lastly, we have the podcast page. So if you have liked anything that you've heard and you want to hear it again, or if you've missed the first half of the show, guys, we had some great questions so far. We talked about 100% first-time buyer programs. We talked about effective interest rate in calculating a refi and paying off credit cards. We covered some good ground. I even got all philosophical on why I believe real estate still makes sense at low appreciation and high interest. If you missed any of that, you can visit MrMortgageRadio.com. That's MrMortgageRadio.com. Dom posts all of the shows up there after we leave the studio. So there's a bunch of them. I think there's 80 or 90 shows up there already. So super excited to be building that library out. But MrMortgageRadio.com if you want more of this. But hey, speaking of your questions, let's throw it over to Dom and get another one on the air.
Paige sent this question. We're looking at a couple of rental properties. Can you explain the landlord loan that you talk about?
Hey, Paige, that's a great question. I love that loan program. And you know, that one, again, it's really, really exciting right now because in the past, well, let me back up and first let me explain the loan and then I'll tell you why I'm so excited about it. That loan product doesn't require income verification from the borrower. So how it works is we're going to verify your assets, we're going to verify your credit, and you typically put somewhere between 15 and 25% down on the property. It's predicated on credit score. And reserves, cash in the bank after you make the purchase. But what's really cool about that loan program is we're not looking at your income to service that debt. We're looking at the property. So if you buy the property and the income, the rental income from that property covers the expenses of owning it, the principal, the interest, the taxes, and the insurance. And if there is an HOA fee, throw that number in there. If the income from the rental covers that, just breaks it even, that's considered cash flow positive and you can fund that deal. So we say that, you know, if the rent covers the bills, boom, you're a landlord. We call it the landlord loan. It's super, super easy. So Paige, look at the rental income of the properties and do the calculation and visit the website, mr.mortgage. There is I think it's under free tools. There's a very robust mortgage calculator in there. Type in the purchase price, the down payment, throw in an interest rate, throw an interest rate of 8.5 or 9% in there to be safe, and work backwards from there and then see if the rent covers that payment, you're good to go. So great question, the landlord loan. And another cool thing about that loan product is you can have 30 investment properties on your portfolio with that loan product before they say, hey, that's a lot. You can't buy any more with the landlord loan. So 30 properties can be purchased with that loan product, all using those same guidelines. So as long as you have the down payment and the cash reserves required and a decent credit score, then you're off and running if the property cash flows. I greatly appreciate that question because I really think that's a good program to take advantage of some opportunity in the market. And in the past, we were looking for positive cash flow, meaning conventional underwriting will only allow you to take 75% of the rental income. So if you're getting $1,000 a month, and guys, I know that's only available in fantasy land right now, but it's easy for me to use round numbers. But let's say the rental income was $1,000 a month and your monthly expenses are $1,000 a month. With the landlord loan, that's considered cash positive. That's a fundable deal. In conventional underwriting, that $1,000 income gets marked down, if you will, to $750. We only use 75% of the income in the calculation. So you can see that that's cash flow negative, and that's not a fundable deal. So the landlord loan's a cool tool. You can use it for short-term rentals, vacation rentals. It's a really neat product. So I appreciate that. If you need more info about it, just give us a call, 855-462-7292, and I'll be happy to answer any of your questions. But speaking of questions, hey, Dom, do we have anything else over there?
We do. Gary called asking, how do I get more information about these lease option programs?
Hey, Gary, that is a great question. I haven't talked about that in a while, so you must have been listening before, or you visited the podcast page, Mr. Mortgage Radio, and listened to a back episode. But yeah, that's super interesting. So we were talking about some of the institutional lease option programs, and we'll cover that here in a second. But for any listeners who are wondering how that works in general, with the lease option, you can give the seller, if you will, the down payment, and then you lease the property, and each month a portion of your payment goes towards that down payment. Now, with the institutional programs, they will require a 5% down payment, and then a portion of your monthly rent, if you will, gets put into an escrow account. So you're building up the down payment savings, and they give you up to 3 years to exercise the option to purchase the property. And the really cool thing about that program, and if you call me off the air, I'll get you all of the information because it's quite complex, but it's super, super cool. There's a predetermined depreciation rate. And guys, right now, that number is coming way down. But you're agreeing to buy that home after 12 months for X amount, after 24 months for Y amount. and after 36 months for Z amount. So it gives you time to get mortgage ready, and you also have already determined your entry point, your purchase point, if you will, as far as the price is concerned. Now, here's something that's super cool. You can walk away from the deal after the first 12 months and get the lion's share of that deposit money back. There is a transaction fee for walking away, but it's a pretty cool program for somebody who's identified the property, but they're not quite mortgage ready, but they're tired of just paying high rent and throwing it out the window. And with that institutional program, you go pick the house you want, they buy it, and then they lease option it back to you. So there's other ways to do it. If you find someone that's selling a property that's willing to lease option it, it works very similarly. It's just you're dealing with an individual instead of a company. But I appreciate that question. Hey, Dom, do you think we have time for another one?
We could squeeze in one more. Charlie sent us a text just before. Our homeowner insurance just jumped in. It's now almost $9,000. I know I can't drop my insurance because we have a mortgage, but can I reduce my coverage?
Wow, Charlie, you are not alone, brother. I just had a conversation on my way to the studio this morning with a friend who's going through the same thing. And they put a new roof on their house, I don't know, last couple years, a beautiful metal roof. But in the back of the house, there's a flat roof section that, hey, I don't know how old it is. I don't think they know how old it is, but it never leaks. It's in great shape. And the insurance company is giving them a runaround because a small portion of that roof is of an undetermined age, and they're requesting them to replace that portion of the roof, and it's nuts. But they're going through the same thing, a big homeowner's insurance premium hike. So sadly, there's not an affordable option out there. What I would encourage you to do is let's connect after I get off the air, and I'm going to get you in touch with one of the insurance agents that we refer a lot of business to, because he's bringing in policies at quite aggressive numbers compared to some of the alternatives. And I don't know how he's doing it, but he's doing it. Now, that's not to say 9,000 is going to turn into 2, but it might turn into 6 or 7. And if anybody can do it, he can. But to answer your question, most mortgage companies are going to require you to carry either the replacement cost of the property or the mortgage balance, whichever is less. And what's happening right now is that replacement cost is jumped quite a bit because of labor costs and material costs. At the end of the pandemic, when the supply chain issues really pushed up construction costs across the board, it affected insurance rates. And a lot of people don't realize that, but it affected the insurance rates because the replacement cost of the properties jumped according to the new material costs and the new labor costs. So the replacement cost or the mortgage amount, whichever's less, you can move your policy amount down to. And your insurance company will tell you what the calculated replacement cost is. They have a formula and software, and they work all that magic behind the scenes. But great question. I'm sorry you're going through that, but I hope that helps. If you need more info or you'd like to get connected to somebody, I'm happy to help you there too. But hey, you hear the music? You know what that means? We are going to go into a quick break. On the other side of this break, we'll be back with more of the show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the REC loan he advertises. Long story short, we did a REC refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Welcome back to to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you heard the man. You're listening to the Mr. Mortgage Show. You can get your questions to us by calling or texting 855-462-7292, but we do have some questions in line, so I'm going to throw it over to Dom, and we'll keep this going.
Another text. This is from Priscilla. My daughter will be heading to college next year. I don't want to pay the high dorm fees, and I'd like to buy a condo or townhouse for her and then keep it as a rental. Will it be an issue to use an equity line for the down payment?
Hey, that is a great question. And man, I got to commend you first for getting a daughter all the way to college. Congratulations. You might have done the prepaid college fund. But anyway, yeah, that's a brilliant question. So, and not uncommon. We have a lot of parents who are buying condos or even, some small homes, and they're keeping them as rental property. So brilliant strategy. But yes, you can use the home equity line of credit to pull out enough money for the down payment, assuming that your debt to income ratios work with that additional debt. But a lot of people are confused because there's the old adage, you can't use borrowed money for a down payment. And that's true if you're just, borrowing it from Cousin Vinny, or you're taking the cash advance against a credit card, but the equity is your money. That's already your money. So you can use the home equity line of credit. You're just going to want to make sure that that additional monthly payment still floats in your debt to income ratio. That's the only caveat, but great strategy. And you can use the landlord loan to go up there and purchase that property. And what's really cool about that is you can Airbnb those properties too. A lot of people do that. Between semesters or, during football season. I know a lot of people who kill it with Airbnb around college campuses. So wonderful strategy, and I'm excited for you. Thank you for that question. Man, Dom, we've had some really good questions this week. We were talking about first-time buyers. We were talking about debt consolidation loans. Where do we think the market's going to go? And now another great question here about purchasing a property on campus or near campus and using that equity line for the down payment. Brilliant strategy. Guys, hey, if you missed any of the show or you're just tuning in and you're curious what we're talking about and you're having FOMO, check out MrMortgageRadio.com. The recorded version of the show, once we get off the air today, we'll post up there later this afternoon, and then you can listen to that as well as, I think, 80 some odd other episodes. So there's a lot of Mr. Mortgage musings online, but that's at MrMortgageRadio.com. But great week so far. I'm super excited. I still believe we're in a good shape real estate wise. I know. Homeowners insurance is getting super expensive and property taxes are super expensive. And don't get me started on that. Property taxes should not be determined by the value of the house. It should be determined by the number of people in the household and the impact that household has on the municipal services. Because if 4 people live in a $500,000 house and that house sells for $1.5 million and 4 people move into it, there's zero additional impact on the community at large. So there's no need for there to be triple the taxes being collected by the government. But that's just me, and I can go off deep and long on that conversation. Maybe we'll do that one day. But hey, guys, you hear the music. You know what that means. We are at the portion of the show where I'm going to ask you a favor. If you've enjoyed any of this, if any of this is valuable to you, if it resonated and you want to share the show, please, I'm hoping I can count on you to help me grow the audience. Share the show by sharing that link, MrMortgageRadio.com, MrMortgageRadio.com. Or if you've got any friends or family or coworkers who are out there thinking about selling or buying real estate and they're just curious, is this a good time? I'd love to talk to them. Please introduce them to me in the show. We'll be happy to help. But guys, you know what that means? That music is indicating that we've wrapped up another week. My God, the time flies. We have so much fun with you. We'll be back here next week, same time, same station. Have a great week. We'll see you then.
That's a wrap. Join Mark-Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.